What if I tell you that you can catch these points within the markets if you know exactly the method of trading the liquidity strategy? Alright, if you stick to the end of this video, you will be able to know how to catch these points within the markets. So stick to the end so that you fully comprehend how to use this particular trading strategy. Firstly, we need to define the underlying principles. Big financial institutions use hefty lot sizes. They talk of 16,000 lots on an entry where their position example will be buy Euro USD at zone of $0.0903, and the lot size for that particular position is going to be 12,000 lots. However, these people would rather die than entering the market before their necessary conditions are met. They will only enter or they'll only take trades when the necessary conditions are met. These conditions is liquidity. Liquidity means free lying money. If there is no money within the forex market, it means they are not going to trade or place a bet. This liquidity is provided by your HIT stop loss, or basically is provided by retail traders. So when your stop loss is hit, where does your money go? I'm sure you've asked a question like this. It becomes a free drop in the exchange ocean where anyone on your opposite bet can take. Therefore, the zones where stop losses are located becomes the region of liquidity pools. So how can we use this information to our advantage? This is the sole purpose of this video. Let's define what we call impulse accumulate impulse effect. There is a simple pattern they present which makes it easy for us to see these points of liquidity in the markets. The pattern is called impulse accumulate impulse. Basically, repetition of one thing. If they push, they need to accumulate, and then they push. This means they move the market, consolidate, and move again later back to the initial point. So this is basically an illustration of what we are talking about. There is an impulse which is basically a drop of price, and within that drop there has been a point of consolidation and then an impulse. So basically your job when using this strategy, you are going to be looking for this effect. Whenever the market gives a push, consolidation, another push, we wait for retest of the accumulation zone, right? So it's basically impulse, accumulate, impulse, and then pull back to the accumulation point for us to get a tradable pattern on the smaller time frame, basically the M5 or even the M1. Let's now have chart examples, but before we see examples, please note that we have a free Telegram channel where we share free setups, signals, and trading tips. I'll leave the link in the description box below. Be sure to be part of our community. Alright, so this is Euro against Japanese yen. I'm just going to start from the recent price points. This is 28 July 2023. We are going to be looking for the phases that we've talked about. As you can see from these lows, we can see that the market actually went to the upside, consolidated, and then went to the upside again. So this is the same exact scenario that we will be looking for. We can see that after the up movement, we had this phase which is a consolidation phase, right? So it was impulse, accumulate, impulse. But the market failed to come back to the accumulation phase. Therefore, it was of no use to us, right? So we can see after that, there was another push to the upside, accumulation, push to the upside. These pushes should be sharp and should show that there is an involvement of large financial institutions. So in this particular case, we can see there was push to the upside, accumulate, and then push to the upside. Impulse, accumulate, impulse, as we have discussed about it. In this particular case, we expect to see the market to come to either the high of this phase or within or below, whatever the case, we will need to see a pattern. In this particular case, we can see there was a first leg, second leg, which can be clearly seen on the M5 time frame, and the market went to the upside like that, right? Going further, we can see as well that we had a move to the upside, pullback, or a phase of consolidation, then another move to the upside. Therefore, it was impulse, accumulate, impulse, like that. So we can safely mark the accumulation phase, marking the high and then the low, protrude it into the future. We can see this is how it happened. Impulse, accumulate, impulse, and the market came back to the accumulation phase like that, right? Which is actually clear. In this particular case, we can see as well there was drop, accumulation, drop, and the market went back to the accumulation phase. We marked the low and the high of the accumulation phase. This was the high, and we can even protrude it in the future to expect and see how it reacted. We had a bearish engulfing pattern, another bearish engulfing pattern, and the market actually went our way. From here, we can see there was a push, accumulation, push, or impulse, accumulation, impulse, meaning that this was a valid point of anticipating these patterns. We can as well mark to the high, right? Protrude it into the future, right? This was the high of this particular impulse, where they came, they retested, they came again, they retested, they came again, they retested to go down with that particular magnitude, right? Going forth, we can see another impulse, accumulation, impulse to the upside like that, and we can mark it this way, protruding it in the future. We can take the low, it was this one, and we can see there was a pattern within that accumulation zone or accumulation phase. So basically, you'll be looking for impulse, accumulation, impulse to find a nameable pattern within that, preferably on the M5 time frame, and enter within the direction of that particular phase. On that note, we've come to the end of our today's video. If you have any questions, feel free to ask in the comments section, and don't forget to give this video a big thumbs up.